Imagine a 102-year-old company that's been in business as long as the automobile's been around. Now imagine it in turmoil, with corporate greed to the very end and a disgruntled billionaire investor. Nope, it's not the latest Netflix special, but it is the biggest news story of the week. Now, don't miss the ending. That's the part where you and I spot opportunities that 99% of traders and investors miss. And on this stock, there's a doozy. Wait till you see it. As we fill in the next chapter of this bankruptcy that I like to call, Dude, Where's My Rental Car? Let's screen it now. Hey everybody, Tom Gentile. Welcome to Tom's Trading Room. Glad to have you here for another video. We're going to talk about Hertz today. We're going to talk about the bankruptcy. We're going to talk about the fundamentals, the technicals, and we're going to look for opportunities as a stock trader as well as an option trader. Let me just say this right now. If you like this video, be sure to hit that like button below and share it with someone that you feel might find this information interesting. Let's get to work. So, like I said, I want to talk about the bankruptcy. I want to talk about the fact that coronavirus had a lot to play in the reason Hertz filed for bankruptcy last Friday. But there are several news items that came out in the week. Hey, bankruptcy. You know what? Hertz told its landlords it was not paying rent for 6 months. All right, that was the latest slam that Hertz did to folks that they rent from. Also, Carl Icahn, he took a slamming this week. In fact, a significant loss. How about $1.6 billion as he exited as Hertz #1 shareholder? All right. The fleet's losing value. You know what? Fleet's losing value because used car prices have been dropping in value again. A lot of supply out there and very little demand. Hertz also, their survival's tied to reducing its fleet. That's going to cause more fluctuation in used car prices. And finally, a bit of interesting news where Hertz actually awarded $16 million in bonuses to its executives days before filing for bankruptcy. So that alone lets me question whether this company is going to survive. Take a look at this chart. This is a chart that goes back to even before the coronavirus became officially a problem here in the States. But if you take a look at their year-end earnings, they still posted a 24-cent loss and cited huge debt loads as part of the problem back there in the middle of February. All right. Fast forward to Q1, which was released on May 11th. A $1.78 loss. And of course, Tuesday morning, the stock opens at 40 cents. Has been in a range this week of between 40 cents and about $1.50. We'll call it $1.49 exactly. So the #1 question that I've been getting from a lot of my followers is, should I buy HTZ? Because HTZ is so low right now. Folks, there's a reason it's low. And before I go any further, let me just say this. You have to believe that #1, these guys are going to come out of bankruptcy. They are a big company, but are they too big to fail? There are other rental car companies out there in the universe. So #1, they have to come out of bankruptcy. And #2, they have to still be trading under the same symbol, HTZ. Because I've seen companies before that go bankrupt, they come out of bankruptcy, but not before they killed the stock, did a new offering under a new stock symbol. All right, so you have to believe that there is light at the end of this tunnel before moving forward. Now, if you do, there's a couple ways you can handle this. All right, first, you could be a stock buyer. You could buy 1,000 shares of HTZ. It's going to cost you, right now, it's about $1 a share. So you're talking about a $1,000 cost for 1,000 shares of stock. The risk on the position? Hey, the risk on this position is the $1,000 investment because there's a very good chance that HTC could go to zero. But what if it doubled? What if it reached a level of 2 and you double your money? That's called a reward to risk ratio of 1 to 1. I want to look at this as an option trader. And You might think, because in a lot of cases, options can be a very great alternative to purchasing stock. Maybe not in this case, because I want to show you what happens to a call buyer when you have a stock that was trading at 20 at the beginning of the year is now trading for $1. All right? So buying calls. First of all, a quick education on buying calls. Buying calls gives you the right to purchase a stock at a particular strike price for a particular amount of time. You pay a right for this with a premium. Your cost and risk is what you paid for the option, and reward on call options is unlimited. All right, so let's go and look at what I see. Okay, here are the option tables on HTZ looking at my site, tomsoptiontools.com. And I've gone out to look at the Jan 2021s because I want to give myself enough time for this thing to turn around and move in our direction if we believe we're going to move higher. So these options have 232 days remaining before expiration. These are long-term options. I want to look at the calls first. So there are two calls that I'm looking at right now. They are the Jan 15, 2021 $1 calls and the Jan 15, 2021 1.5 calls. All right. So we could look at this and we could simply buy the $1 calls. They're going to cost us about 50 cents to purchase these calls. So I have between now and January 15th, 2021 for the stock to rise. If I buy these call options, all right, here's what it's going to look like if I were to go in and actually purchase the $1 calls. All right, now if I purchase one contract of those, then it's going to end up costing me $50 for the trade. All right, $50 for the trade, and then look and see what you're doing here. You're buying the January 15, 2021 $1 call. You're going to pay 50 cents for it, and so add that to the dollar, and that's your break even by the end of, well, the January 15, 2021. So the risk graph looks like this. Yeah, you're risking $50, all right, and not $100 for 100 shares of stock, all right? If you were going to equate this to 1,000 shares of stock, you'd buy 10 calls. That means it would be a $500 cost to your position. So half the cost of the stock, but here's the problem. Your break even is going to be up here. Your break even is at $1.50, all right? Break even on a stock is only $1, but the break even on the call option is you take the strike price plus the premium you paid. That is your break even at expiration. So another thing we could do is we could look at puts. And by selling puts, we are, in essence, going long on the stock. We are bullish on the stock. Now, selling puts is different than buying calls. Buying calls give you a right. Selling puts give you an obligation. You are obligated to purchase a stock at a strike price. Now, you get paid a premium for this obligation, but your risk on the position is if the stock goes down to zero. Your reward is limited to the premium received, but it does come with a higher probability of profit. Now, this is what makes it very interesting with Hertz. All right, take a look at what I can do with these put options. Let's slide back over and take a look here. So now I'm going to look at the puts. And the put options, I have the $1 puts, I have the $1.50 puts. Forget the 150s. The $1 puts, right now, if I were to sell these, all right, the worst I could do based on the prices I see right now is 65 cents. That means I'm going to take in 65 cents or $65 for every one put that I sell. This is what this looks like on a risk graph. Take a look at this. And you're not going to see this too often with put options. Take in $65. Well, what's my risk? I've heard puts are risky, Tom. Well, they are because the stock could go to zero. But if the stock's at $1 and you're going to receive 65 cents to sell the $1 put, guess what your risk is? Your maximum risk is $35 on the trade. So the only thing that has to happen is, again, Hertz has to stay above 35 cents a share for you to be at break even or better. If it goes to zero, you're out $35. If it stays above $1, you make $65. This is a 185% reward to risk ratio that you see here by selling the puts. Take a look at the graph. Same thing. We see a situation where As long as Hertz remains above $1, you maximize your profit potential, in this case, $65. If Hertz drops, your break even is at 35 cents. And if Hertz goes to zero, obviously you lose $35 per contract on the trade. In summary, I just want to say this. Number one, there is still a high probability that Hertz will not come out of Chapter 11 and be forced to Chapter 7. But if you believe that they will come out of bankruptcy for one reason or another, and you like this company, there are multiple ways to be bullish. All right, so each strategy that I outlined today has different costs, has different risks, has different rewards, and has different probability outcomes. Thanks for joining me on this video. I post videos like these up on a regular basis. Be sure to subscribe and hit that bell so that you can be notified when my next video is uploaded. And hey, if you like this video, feel free to share it with others and give me some love by hitting that thumbs up down at the bottom of the screen. I'll see you on the next one. Bye now.